Hey, everybody. Hopefully, you're having a good day. Hopefully, you're killing it in the markets. My name's Andy. My channel's Finding Value. If you like making lots of money, maybe even copious amounts, this channel's for you. Subscribe to the channel. Give me a thumb up for this content. I'm going to talk about price movements and what really moves price. I know a lot of people think that the fundamentals of a company moves its price, but I'm going to give you my opinion on what I think exactly moves the price of the majority of companies on the stock markets. So here is price movements, and maybe perhaps some people may disagree with me, but this is what my opinion is on what moves price. So what moves price? What ultimately moves the price? And this is my opinion. It's the rotation of money and money flows. It's earnings, commodity prices, market conditions, interest rates, dollar value. But you could really take out earnings because that's really tied to commodity prices if it's a commodity price producer. But then you could take out commodity prices because really that's just an underlying condition of market conditions. But then you could say, well, market conditions aren't necessarily what's driving it. It's really interest rates. But then you could say that interest rates are really, it's really inflation or the dollar value. And that's how I have it kind of going across from left to right. So really the right is the root cause, and it's the value of the dollar or inflation. Money flows are what drives prices higher, and basically it's investor perception, and it deals with money rotation and flows. Sometimes earnings or even commodity prices do not have a direct correlation to price movements at some times. So I'm going to talk a little bit more about money flows. And I think that money flows have the largest impact to asset pricing more than anything. And money flows have the largest impact, and it's really the market conditions. And what I mean by market conditions, what I mean is interest rate changes and inflation changes. Those two things really are what drive entire sectors up or down. Market conditions change from commercial bank lending. So that's kind of what changes the market conditions is the commercial bank lending. And ultimately, what changes it is demographics. And demographics ultimately drives changes in commercial bank lending. So they talk about real estate loans, business loans, growth in product demand, etc. So I would say that demographics are probably the most important thing in terms of investing in a country, because that's really what drives everything. So what should investors be focused on? What is my message here? Demographics should be at the top of your list for investing in countries or areas. We have market conditions where weakening dollar is a high likelihood. Inflation is basically what I'm talking about. Emerging markets are a good spot to be with a declining dollar and with demographics and commodities doing well. I think everyone should take a good hard look at emerging markets. We should be focusing some time and effort into emerging markets and doing our homework in those areas. Because we have a commodity boom, which they do very well during commodity booms. They have currencies that are outside of the United States dollar. And if the dollar is declining, and we have investments outside of the dollar, I think that's a very good spot to be. Plus, their demographics look exceptional for a boom and growth. So my take on this is be first. Ratios tell us what is cheap and where the money has flowed out of. So if the ratio is cheap, money's already flowed out of that asset. It's flowed to something else, and we can tell that through ratios. And that's why I use ratios and ratio investing. It tells us what assets are cheap. Basically, it's telling us where the money has flowed out of. We look at market conditions to tell us when money rotation could happen. And really, in my opinion, the real estate market tells us this because that's where inflation comes from. Demographics drives up real estate. Real estate drives up inflation. Inflation drives up interest rates, and interest rates changes money rotation. Then we invest before everyone else enters the area. That's why we go into what's cheap. And when the market conditions tell us that they're changing, we need to get in there first before everyone else. We're going to go to the party. We're going to be first at this party. Yes, it's going to be boring in the beginning, but when everyone else shows up, you know what? All their money shows up with them. And we get revalued much, much higher than what we did when we first entered into those positions. Commodities are the spot to be right now, in my opinion. Valuations and market conditions. The market conditions are changing. We're getting inflation. Interest rates are going up, which means commodities are the spot to be in because the ratio is telling us that those valuations have never been this cheap. So ratios and the path. I just want to kind of reiterate this because ratios tell us what is cheap. But, it does not tell us the path to get to expensive. It also doesn't tell us the time it takes to get there. So we may take a path where we might go down 20%, 30%, maybe even 40%, and we already purchased at 90% off of its highs. But we could still go down quite a bit. I propose that we know that it's cheap, we know the conditions are changing, so we need to continue to cost average in if that occurs. The path does not dictate if an asset is good or bad. And I know a lot of people who are new investors, they buy something, it goes down 10 or 20%, and they get scared because they want price to validate their purchase. And what I'm telling you is you're looking for the validation in the wrong spot. You need to look at other things rather than price of that stock. Look at the commodity and the overall big picture. And if you see the asset go down, you should be excited to purchase more. That's the mindset you need to get into. The ratios tell us what's cheap. So the ratio, if it's cheap, you should not worry about the path per se. Continue to cost average in, get your shares. Because when it comes around and the money flow comes to our assets, they're going to get repriced much, much higher. And again, this could be very volatile and it could move against us for a while and sometimes. So my opinion and my take on it has been to cost average into positions for this reason. And we can know something's cheap and we can see that the market conditions are slowly starting to change. So we may have 6 months, year, 2 years to cost average into positions. I've been cost averaging into positions since 2018 and it's 2021 right now because the ratios were cheap and I could see that the conditions were slowly changing. And so I was rotating out of some technology companies that I was in slowly into commodities because commodities is where it is at, in my opinion. So the conclusion here is money flows, which moves price. Market conditions spurs that money flow. And ratios tell us where we should be before money flows. Be first and win at life. That's what I say, at least in investing. So from a very big picture, guys, very big picture, if you were to step back, money flows is what changes prices. Market conditions change money flows. Market conditions basically can tell us when that rotation is about to happen. The ratios tell us the valuations. You tie those two things together, you're now a professional investor. It is that simple, in my opinion. Now, I know people, they want to get down and do all the fundamental analysis, but I can tell you that fundamental analysis isn't going to get you anywhere unless you get this right. If you get this right, a big if you get this right, everything else will fall into place. I mean, you could literally throw darts at the wall at certain companies, doesn't matter what they are, and you'll make money. Tech companies in a lowering interest rate environment where they drive it into zero, you're going to make money. Doesn't matter which one. PE ratios, doesn't matter anymore. Earnings, fictitious. We're discounting future ideas right now on half these companies that are electric vehicle companies. They don't have any earnings. They can't even source the nickel for their future products that they have. They can't even get it. At least that's my guess. And they're not going to get it for the price that they think they're going to get it for. Not even close. These prices are going to be 4 times higher than what they discounted in their cash flow models. Way higher. So what I'm saying is, to be a successful investor, If you know these things that I'm teaching on this channel, if you understand how markets work, the interest rates, the inflation, that money rotates and really sets the price of assets. Those conditions set the price of the assets because money starts to flow and move around under certain conditions. You will win as an investor if you know this stuff. If this interests you, subscribe to the channel, give me a thumb up for this content. Leave comments below if this doesn't make any sense to you. I want to know that everyone is getting a good grasp on this information, because this is huge. This is how you can win at being an investor. If you don't know this stuff, you are blind. Like, you don't know what to go into, and you don't know what's going on. You don't know why certain sectors are going up. You don't know why other ones are going down. It doesn't make any sense. This hopefully makes sense to you. And if it doesn't, put it in the comment section. Ask questions. I can do other videos to help you guys understand market conditions, valuations, and money flows. Because this is what, maybe your stack is this big right now. I want it to be huge, of $100 bills or precious metals, ounces of gold, or whatever it may be. That's my goal, is to make you guys better investors. Thank you for listening. This is Finding Value.